It's a Tuesday morning. You're standing in your kitchen holding a cup of chai or coffee, half listening to the morning news while your kids argue about backpacks and shoes. Your phone buzzes. You glance down casually, expecting a delivery notification or maybe a reminder from school. Instead, you see three words that make your stomach drop. IRS notice of penalty. For a moment, you tell yourself it has to be a mistake. You pay your taxes, you work hard, you follow the rules, then you open the email. The subject line continues, unreported foreign financial account, and below that, a number jumps off the screen, 16,536. Your heart starts pounding. You scroll faster, trying to understand what this is about. And then it hits you. That old savings account back home, the one your mother's name was on, the one you barely used, the one you honestly forgot about. You never thought the United States cared about a small bank account in India or Pakistan or Nigeria or Mexico. You never imagined that something sitting quietly in another country could suddenly threaten everything you built here. Your green card, your citizenship application, your reputation, your savings. But here's the reality no one warned you about. America does care. And in 2026, the system designed to find unreported foreign accounts is more powerful, more automated, and more unforgiving than ever before. This isn't just about a fine. This can affect your immigration status, your citizenship interview, your entire future in this country. And the most dangerous part, most immigrants don't even realize they've stepped into this trap until the letter arrives. In the next few minutes, I'm going to break down exactly how this happens, why so many hardworking people get caught, and the precise steps you can take right now to protect yourself before a forgotten account turns into a $16,000 nightmare or worse. Hi, I'm Sofia, and welcome. On this channel, we break down immigration and financial rules that directly impact immigrants in the United States clearly, calmly, and without the legal confusion that leaves people scared and overwhelmed. If you are a green card holder, a naturalized citizen, or someone preparing to file your N-400, this conversation is not optional, it's essential. Today we are going to talk about foreign bank accounts, FBAR reporting, FATCA rules, worldwide income, and the very real way a simple reporting mistake can delay or even derail your citizenship. But we are not here to panic. We are here to replace fear with clarity. I'm going to show you where the $10,000 rule confuses people, how the IRS already receives foreign banking data, what good moral character really means during a citizenship interview, and most importantly, the exact legal protections available if you made an honest mistake. Because let me say this clearly at the beginning, having a bank account in your home country does not make you a criminal. Supporting your parents does not make you a criminal. Owning property abroad does not make you a criminal, but not understanding the reporting rules can create serious consequences. By the end of this video, you will know exactly what applies to you, what deadlines matter in 2026, and what steps to take tonight to make sure an old account never threatens your American future. And trust me, once you understand how this system really works, you'll see why so many people get caught and how you can make sure you're not one of them. Let's talk about the trap. Because this isn't random. This isn't bad luck. There's a pattern to why so many hardworking immigrants end up staring at penalty notices they never saw coming. And the trap has three layers. The first layer is what I call the $10,000 misunderstanding. Almost everyone hears that number and immediately relaxes. I don't have $10,000 sitting in one foreign account. They think I'm safe. But that's not how the rule works. The law doesn't care how much is in one account at the end of the year. It doesn't even care what the balance is today. What matters is the highest combined total across all your foreign financial accounts at any single moment during the entire calendar year. Let that sink in. Not one account, not December 31st, not what's there right now, the highest combined balance, even if it happened for one day in January. So imagine this. You have a savings account back home with $4,000, a small checking account with $3,500, and maybe a fixed deposit or insurance policy with a cash value of $3,200. Separately, none of them crosses $10,000, but together that's $10,700. And if for even one day those balances existed at the same time, you triggered a reporting requirement, even if by the end of the year the accounts were nearly empty, even if the money wasn't technically yours, but you were listed as a joint owner. Even if you forgot the account existed, the requirement was triggered and most people never realize it. That's layer 1. Layer 2 is the part that makes people uncomfortable. The IRS doesn't need you to tell them anymore. In 2026, the government isn't relying on random audits or tips. It's relying on data. Under a global agreement called FATCA, the Foreign Account Tax Compliance Act, banks in more than 100 countries are legally required to report account information belonging to U.S. persons. That means your bank in Delhi, your savings account in Karachi, your account in Lagos or Manila or Guadalajara. If your name is connected to it and you are a U.S. citizen or green card holder, that data can be transmitted to the U.S. government quietly, automatically. And now, instead of hiring thousands of new agents, the IRS is using artificial intelligence to cross-reference that foreign data with the tax returns you file here. The system looks for mismatches. Accounts reported abroad but not reported on your FBAR. Interest income earned overseas that never appears on your Form 1040. It flags patterns. It sends notices. So when people say the IRS will never find out, they're thinking about 2005, not 2026. Today, the question isn't whether the IRS can see the account, it's whether you reported it first. And then there's layer 3, the one that truly raises the stakes, citizenship. If you are applying for naturalization using Form N-400, one of the requirements is that you demonstrate good moral character. During your interview, you will be asked questions about your tax history. Have you ever failed to file a required tax return? Have you ever lied to a U.S. government official? Have you ever failed to report income? If you were required to file an FBAR and you didn't, and then you check no on a question asking whether you failed to comply with tax obligations, you may have just made a false statement under oath. That's not just a paperwork issue anymore. That can delay your application. It can trigger further review. In serious cases, it can result in denial. And if there's evidence the failure was intentional, it can open the door to much deeper legal trouble. The trap is not just financial, it's legal. It's immigration. It's your long-term security. And the heartbreaking part is that most immigrants who fall into this trap aren't hiding money offshore. They're supporting family. They're holding on to a small inheritance. They're keeping a joint account for convenience. Nobody explained the reporting rules clearly, but once you know the rules, silence stops being an option. Now let's shift from the trap to the shield, because the law doesn't just punish, it also protects. But those protections only work if you use them correctly. The first shield is called FBAR, officially FinCEN Form 114. FBAR stands for Foreign Bank Account Report, and despite the name, you don't file it with your regular tax return. It's filed electronically through the Financial Crimes Enforcement Network system. The rule is straightforward in theory. If the combined total of all your foreign financial accounts exceeded $10,000 at any point during the year, you must file NFAR. The deadline is April 15, 2026 for the 2025 tax year. The good news, there is an automatic extension to October 15th. You don't have to apply for it. It's automatic. But automatic does not mean optional. What counts as a foreign financial account? Savings accounts, checking accounts, joint accounts, accounts where you only have signing authority, certain foreign retirement accounts, some insurance policies with cash value, even accounts that are dormant but still open. If your name is attached and the threshold is crossed, reporting is required. Now, let's talk penalties because this is where fear starts creeping in. If the IRS determines that your failure to file was non-willful, meaning you didn't know about the requirement and had no intent to hide anything, the penalty can be up to $10,000 per violation. In practice, that often means per year. But if the IRS believes the violation was willful, meaning intentional concealment, the penalty becomes much harsher. The greater of $100,000 or 50% of the account balance. And in extreme cases, criminal charges are possible. That's why this issue must be handled carefully. However, and this is important, there is a shield inside the shield. If you realize you made a mistake and you come forward voluntarily before the IRS contacts you, you may qualify for a program called the Streamlined Filing Compliance Procedures. Under that program, people living abroad can sometimes reduce penalties to zero. Those living in the United States may face a reduced penalty, often around 5% of the highest aggregate balance. The difference between voluntary correction and waiting for an IRS notice can literally be tens of thousands of dollars. And if this is already clarifying something no one ever explained to you, make sure you subscribe so you never miss critical updates like this. Because rules change, enforcement evolves, and staying informed is one of the strongest protections you have. Now, the second shield is Form 8938. This form is related to FATCA reporting, and it is filed with your regular tax return, your Form 1040. Unlike FBAR, which focuses on bank accounts and has a $10,000 threshold, Form 8938 has higher reporting thresholds and covers a broader range of foreign financial assets. If you are single and living in the United States, you must file Form 8938. If your foreign financial assets exceed $50,000 on the last day of the year, or $75,000 at any time during the year. If you are married filing jointly, those thresholds increase to $100,000 on the last day or $150,000 at any point during the year. And what counts as foreign financial assets here? Bank accounts, yes, but also foreign stocks held directly, ownership interests in foreign businesses, certain foreign trusts, and more. Many people are surprised to learn they may need to file both FBI and Form 8938. They are not substitutes. They are separate reporting systems with separate thresholds and separate penalties. One does not cancel the other. Finally, there is the worldwide income rule. If you are a U.S. citizen or green card holder, the United States taxes your worldwide income. That means interest earned in your foreign savings account is taxable here. Rental income from property abroad is taxable here. Business profits earned overseas are taxable here. Now, that does not necessarily mean you will pay tax twice. The foreign tax credit claimed using Form 1116 allows you to offset taxes paid to another country against your U.S. tax liability. The United States also has tax treaties with many nations, but the key is disclosure. Reporting is required even when no additional tax is owed. The system is built on transparency. And once you understand how these shields work, FBI, Form 8938, worldwide income reporting, you begin to see the bigger picture. The danger isn't having foreign accounts. The danger is not reporting them correctly. And in just a moment, we're going to talk about what to do if you already missed previous years, because that's where the real turning point happens. Now, let's talk about the question that's probably sitting in the back of your mind right now. What if you already missed it? What if you're watching this and realizing that for the past 2, 3, maybe even 5 years, you should have filed an FBAR and you didn't? This is the moment where most people panic. And panic is exactly what gets people into deeper trouble, because when fear takes over, people freeze. They ignore it, or worse, they file something rushed and incomplete without understanding the legal consequences. But here's what you need to understand. The IRS knows that many immigrants fail to report foreign accounts, not because they're criminals, but because they genuinely didn't know the rule. And that's why there is a formal pathway designed specifically for honest mistakes. It's called the Streamlined Filing Compliance Procedures. This is not a loophole. It's not a trick. It's an official IRS program, and it can be the difference between manageable correction and financial devastation. Here's how it works. If your failure to report foreign accounts or foreign income was non-willful, meaning it was due to negligence, misunderstanding, or lack of awareness rather than intentional concealment, you may qualify. The key word is non-willful. You must certify under penalty of perjury that your conduct was not intentional. That certification is not something you take lightly. It must be truthful. Under the Streamlined program, you generally file amended tax returns for the last 3 years and delinquent FBARs for the last 6 years. If you live outside the United States, penalties may be reduced to 0. If you live inside the United States, there is typically a reduced penalty calculated at 5% of the highest aggregate balance of your foreign financial assets during the covered period. Compare that to potential willful penalties of 50% per year. The difference is enormous. But here is the critical part. You must act before the IRS contacts you. Once you receive an audit notice or a formal penalty letter, your ability to use the streamlined procedure may disappear. The system rewards voluntary compliance. It punishes silence after detection. That's why timing matters so much. And this is where many people make a dangerous mistake. They assume that because the account was small or because it earned only a few dollars of interest, it's not worth fixing. But immigration law doesn't look at this through the same lens as accounting. Immigration officers don't calculate percentages. They look at patterns of compliance. If you are applying for citizenship, the government will evaluate whether you have demonstrated good moral character during the statutory period, typically the last 5 years or 3 years. If you're married to a U.S. citizen, consistent tax compliance is a major part of that evaluation. When you sign your N-400, you are affirming that everything you provided is truthful and complete. During your interview, the officer may review your tax transcripts. They may ask whether you have ever owed back taxes. They may ask whether you have taxes. They may ask whether you have ever failed to file required forms, and ever failed to file required forms. And here's what many people don't realize. USCIS can request IRS records directly. If the IRS database shows unreported foreign income or missing FBARs, and you foreign income or missing FBARs, and you answer no to questions about compliance, you create a credibility issue. You create a credibility issue. Even if the original mistake was innocent, a mismatch between your sworn answers and government records can trigger delays, requests for evidence, or deeper scrutiny. Let's make this practical. Imagine someone who became a green card holder in 2018. They kept a small joint account overseas with their father. The balance crossed $10,000 briefly in 2022 when property was sold, and the funds sat there temporarily. They didn't know about FBAR. In 2026, they apply for citizenship. During the interview, the officer reviews tax compliance. A question arises about foreign income reporting. Now, the applicant is sitting there trying to explain something they never reviewed carefully. The officer may continue the case and request proof of compliance. Weeks turn into months. The stress builds all because something that could have been corrected quietly beforehand wasn't addressed. That's why I always say fix the problem before you file for citizenship, not after. Walking into an N-400 interview with unresolved tax issues is like walking into an exam without studying. You're increasing risk unnecessarily. Now, let's talk about something even more serious. What if the IRS believes the failure was willful? Willful means intentional concealment. It means the government believes you knew about the requirement and chose not to report. That's when penalties escalate dramatically. Civil penalties can reach the greater of $100,000 or 50% of the account balance per violation. In extreme cases, criminal charges are possible, especially if there's evidence of structured transfers, false statements, or deliberate efforts to hide ownership. Now, I want to be very clear here. Most everyday immigrants with small accounts supporting family members do not fall into this category. But the way you respond matters. Ignoring notices, providing false explanations, submitting incomplete disclosures after contact. Those actions can shift a case from non-willful to willful territory, and that shift is what creates long-term damage. This is also where the citizenship risk becomes more complex. Naturalization requires that you demonstrate attachment to the principles of the Constitution and good moral character. If there is evidence of tax evasion or intentional misrepresentation, USCIS can deny your application. In rare but serious cases, if someone already became a citizen, and later it's discovered that they obtained naturalization through concealment of material facts, the government can initiate denaturalization proceedings. That is not common, but it exists, and it usually begins with misrepresentation under oath. So when we talk about foreign account reporting, we are not just talking about numbers on a form. We are talking about integrity in a legal process that evaluates your honesty over time. Now pause for a moment and breathe, because this is the part where anxiety can spike. But information is power. If you are still within the statutory period for citizenship and you discover a reporting gap, you have time to fix it. The law does not require perfection. It requires honesty and corrective action. Officers understand that tax rules are complicated. What raises red flags is avoidance, not correction. If you discover a mistake and proactively amend your filings, pay any owed tax, and document your compliance before submitting your N-400, you dramatically reduce the risk of denial based on tax issues. And if you are currently preparing your citizenship application, here is something I strongly encourage. Before you submit that form, request your IRS tax transcripts for the last 5 years. Review them carefully. Confirm that all required FBARs were filed. Confirm that foreign income was reported properly. If there are discrepancies, consult a qualified tax professional who understands international reporting. And if you have any history of penalties, payment plans, or amended returns, speak with an immigration attorney before filing. Preparation transforms uncertainty into control. If you are on your citizenship journey right now, do not rush this step. A clean tax record strengthens your case more than you realize. And if this video is helping you connect the dots between tax compliance and immigration security, share it with someone who is preparing for their interview. Too many people focus only on civics questions and English tests, but overlook the financial compliance piece that can quietly delay everything. In the next part, we're going to get extremely practical. I'm going to walk you step by step through exactly what to do tonight. How to calculate your exposure, how to determine which forms apply to you, and how to build a compliance plan so that an old foreign account never becomes a threat to your American future. Let's make this real, because laws and forms are one thing. Real life is another. And sometimes the fastest way to understand your risk is to see how this actually plays out for people just like you. Picture this. A man moved to the United States 15 years ago. He worked 2 jobs, sponsored his wife, bought a small home. Back in his home country, he kept a joint savings account with his mother. The balance usually stayed around $6,000 or $7,000. 1 year after a small piece of family land was sold, his portion, about $8,000, was deposited temporarily into that account. For a few weeks, the total balance crossed $14,000. Then the money was distributed among relatives and the account dropped back down. He never thought about it again. Years later, while preparing his citizenship paperwork, a tax preparer casually asked, "Did your foreign accounts ever exceed $10,000 combined at any point during the year?" That's when he froze, because he genuinely didn't know that temporary spike triggered an FBAR filing requirement. Now, here's the key difference. Instead of ignoring it, he addressed it before filing his N-400. He worked with a qualified professional, submitted delinquent FBARs, documented that the failure was non-willful, and corrected his filings. By the time he walked into his citizenship interview, the issue had already been resolved. No drama, no denial, just preparation. Now, compare that to another scenario. A woman receives a notice from the IRS about an unreported foreign account. She panics. She feels ashamed. She assumes it must be a scam or a mistake. She ignores it for months, hoping it disappears. It doesn't. A second letter arrives. Now penalties have grown. Interest has accumulated. She finally responds. But by this point, the IRS is no longer viewing it as a simple oversight. The tone shifts. What could have been resolved quietly becomes adversarial. The lesson here isn't fear, it's timing. Silence makes small issues bigger. Here's another scenario that directly connects to citizenship. A green card holder applies for naturalization. During the interview, the officer reviews tax transcripts and asks whether all foreign income has been reported. The applicant confidently says yes, but the IRS records show no FBAR filings for the past several years, despite foreign bank reports under FATCA. The officer issues a request for evidence asking for proof of compliance. The case is continued. Months of waiting follow. The applicant scrambles to file late forms while under review. Stress spreads through the entire household. Children ask why the ceremony date hasn't come. All of this could have been prevented with a pre-application compliance review. And then there are the rare but serious cases: intentional concealment, large undisclosed accounts, structured transfers to avoid reporting thresholds. These are the cases where willful penalties and even criminal investigations arise. That is not the typical immigrant supporting family overseas. But the government does not automatically know your intent. Your documentation, your transparency, and your response determine how your situation is classified. So now let's move into action mode. No more hypotheticals, no more abstract warnings. Here is your step-by-step plan. And I want you to think of this as a checklist you can start tonight. Step 1. Create a complete foreign account inventory. Not just the accounts you actively use, every account. Savings, checking, fixed deposits, investment accounts, insurance policies with cash value, joint accounts where your name appears, even if the money isn't technically yours, accounts where you only have signing authority. Write them down, list the financial institution, account number, and country. Step 2. Determine the highest balance for each account during the year. This is critical. You are not looking at December 31st. You are looking for the highest value each account reached at any point during the year. If you don't have exact statements, request them from the bank. Accuracy matters. Step 3. Add those highest balances together. Combine them. Ask yourself, did this total exceed $10,000 at any moment during the year? If yes, you likely triggered an FBAR requirement. Mark the deadline clearly. For the 2025 tax year, the FB is due April 15, 2026, with an automatic extension to October 15, 2026. Automatic does not mean optional. It means you have extra time, but you must file. Step 4. Evaluate Form 8938 requirements. If you live in the United States and are single, did your total foreign financial assets exceed $50,000 on the last day of the year, or $75,000 at any time during the year if married filing jointly? Were those numbers above $100,000 on the last day, or $150,000 at any time? Remember, Form 8938 includes more than just bank accounts. It can include foreign stocks, partnership interests, certain foreign retirement accounts, and other specified assets. If the threshold applies, this form must be attached to your tax return. Step 5. Review your worldwide income. Did your foreign accounts earn interest? Did you receive rental income from property abroad? Did you receive dividends or business profits? All worldwide income must be reported on your U.S. tax return, even if you paid taxes abroad. This is where the foreign tax credit comes into play, typically claimed on Form 1116 to prevent double taxation. Reporting does not always mean paying more tax, but failing to report creates exposure. Step 6. If you discover past noncompliance, evaluate the Streamlined Filing Compliance Procedures immediately. Do not wait for a letter. Consult a tax professional who understands international reporting. Prepare amended returns if necessary. Submit delinquent FBARs. Provide a truthful, non-willful certification if applicable. Acting voluntarily keeps you in control of the narrative. Step 7. If you are preparing to file Form N-400, conduct a citizenship compliance audit before you apply. Obtain your IRS tax transcripts. Confirm that all required forms were filed.